The stock market is rallying today as we await the Fed and as we have gotten Microsoft and Alphabet earnings. Now, Microsoft and Alphabet missed on top line revenue and they missed on bottom line earnings. They missed across the board, but there was some rosy guidance out of Microsoft, and Google's search data was up a lot more than expected. So that's why those stocks are rallying. I'm not sure you can call that a victory. It kind of goes to show where stock valuations are. It doesn't take a beat to make these stocks go higher. It just needs a overall consensus that the situation is not getting worse. So we have a lot to talk about. The Atlanta Fed GDP Now tracker did estimate and reevaluate the negative GDP print that we are supposed to get tomorrow. So I want to go over that, and I want to talk about a couple other key things that are happening. As you guys know, we have the Fed meeting today at 2 p.m., and then we have the press conference, and we're going to clarify what is expected to be said at that just in about 2 hours time. So hit that like button and subscribe to the channel if you guys have not already, and if you guys want to come trade with me live in real time, link down below in the description. That will never be cheaper than where it currently is, so take advantage of that if you guys want to. Now, first and foremost, like I said, the reason why we are up today is Microsoft and Google earnings, and it says it right here. Alphabet shares rose 5% after the tech giant's quarterly report showed strong revenue from Google's search business. That said, the company's overall earnings and revenue came in below expectations. Microsoft also posted earnings and revenue below analyst estimates, but reported a 40% jump in revenue growth for Azure and cloud services. Shares popped 5%. So as long as the situation is not getting worse or it's not deteriorating at a more aggressive pace, well, that looks to be a positive thing for the stock market. And that goes to show, like I said, where the valuations are for stocks. It's not that high, especially for Google. Like, you're trading at a 18, 19 PE, even a Microsoft at 23, 24. As long as you can still grow, investors are okay paying that. Now, if you start to show real negative growth, like something like a Facebook is, well, that's where you have a problem, even with a low valuation. Facebook, we get those earnings today in after hours, and they are by far the lowest value of any of these tech stocks that we are going to be getting reports of this week. Facebook is trading at like a 12 PE ratio. It's astronomically low. You have some dividend stocks that are trading 3-4 times the valuation what Facebook is trading at. So be careful of that. It's not going to take a lot of good news to get a pretty decent rally out of that stock. And that's what we have for after hours. Facebook, Meta, whatever you want to call it, Ford, Qualcomm, Holistic, Teladoc, Etsy, Lam Research, ServiceNow, Anai, and QuantumScape. But the real story is going to be the Fed today. We are expecting a 75 basis point rate hike. It's possible we get a 1% rate hike, but not very likely. It's been like 40 years since the Fed went against what the markets are pricing in during a normal Fed meeting, and the markets are pricing in a 75.7% chance of a 75 basis point rate hike. So that's what we're going to get. 24.3% chance of a 1% rate hike. So pretty much it's not going to happen. And we do have 2 hours, 26 minutes until 2 p.m. until we get the Fed rate decision. Now, how this works, if you guys are unfamiliar with these days where the Fed raises rates. So essentially what happens at 2 p.m., you get the report, you get, who voted for what, who dissented, who didn't want to do this rate hike. You get some of that information. You get an overall report of the economic activity, why they're doing a 75 basis point rate hike, what they're kind of concerned about, and that's that. You will see a big market reaction around 2 p.m., and that's really just based off of the rate hike, what the markets are expecting. But then at 2:30, that's where you get less scripted answers from Fed Jerome Powell. At 2 p.m., it's just a report that comes out. It's all a script. So the Fed can really say whatever they want and try for a market reaction, right? The Fed obviously wants the markets to price in more tightening. So that's probably what you'll get. You'll probably get the bonds, the bond yields that do shoot up, and that's would be expected. That could cause some downside pressure to the stock market as bonds go up. Stocks typically do come down. Then at 2:30, you will get Fed Jerome Powell. He'll give us that scripted, script of what he usually does, and then you'll get the questions from analysts, and that's what usually moves the markets the most. And a lot of people are paying attention to this next meeting, which is September 21st. We don't have a reading for August, so we're actually going to get two of everything: two PCE reports, two CPI reports, two labor reports, two unemployment reports. We're going to get two of everything before that next meeting. And essentially, people want to see, is the Fed going to slow down the pace of raising rates, or are they going to signal that they're going to go even more aggressive? I think that's the difference between, a 3 to 4% up day tomorrow and a 3 to 4% down day tomorrow. Now, on top of all of that, we still have the largest companies that report earnings on Thursday, which is Apple and Amazon. I'm quite concerned about these two more than the other ones that we have got, right? Google, Microsoft, and Facebook. I'm really concerned about Apple and Amazon just because of the long-running thesis I've had. Simple Econ 101, when you take a stagnant business that really benefits from all this funny money excess demand that is artificial, right? Government handouts. It made a lot of business for Amazon and Apple. Well, what happens when that money is gone, which I believe a lot of that money is gone? What do the numbers look like? And just Econ 101 here, keeping it simple. You get an expansion off of something artificial, and then it goes back to normal. Well, you will see a contraction, and we have not seen that contraction yet. Definitely not priced into the stocks of Amazon and specifically Apple. If that starts to show its ugly face this earnings season, well, that could be bad. You also have the Q2 GDP estimates that come out on Thursday as well. We are now expecting a negative 1.2% GDP print. The White House, shout out young Biden, has come out and tried to change the definition of a recession. They now don't want to call it 2 negative quarters of declining GDP growth. They want to call it all these other factors, manufacturing data, all kinds of stuff. They want to factor unemployment into it, all of that, which is fine if you're talking about like a 2008 kind of recession. But if you're just talking about a mild recession, well, it doesn't necessarily have to mean unemployment has to go to 5, 6, 7, 8, 9, 10%, or you have to see manufacturing come down in a major way. It just doesn't have to be the case. So I think Wall Street will, consider us in a technical recession coming Thursday when we get that negative GDP print. And depending on what the Fed does today, that's going to be the key, and that is really going to be what moves the markets from here. The markets, sure, that they care about all these other external factors. They care about earnings. They care about all of that. But when it comes down to it, the Fed controls money. When the Fed gives easy money like they have in the last 15 years, it's pretty easy for the stock market to go up. Right? You always know the Fed is your backstop. If the Fed pushes us into this recession and they are no longer our friends because of inflation, well, that's where you have a big problem, and that's where Fed policy will dictate how stocks trade. And that is why you have seen so much multiple compression here in 2022. It's based off of the Fed. And what you're actually seeing today, which this is probably the most wild part of all of today. Yes, the stock market is up quite dramatically today. Pretty obvious here that it's doing very, very well, right? Let's go ahead and log in, actually. And the stock market, the S&P 500, up 1.44% right now, approaching 397. So it's a very strong day. The NASDAQ up well over 2%. But if you take a look at the yield curve is inverted 0.31 basis points. So what the markets are actively doing right now is pricing in a recession. The markets are saying over the next 2 years, you're going to see a Fed error, and we do not want to own these 2-year bonds. That's why investors sell the 2-year bonds, make those yields go up, but then they go out and buy the 10-year bonds, driving those yields down. So what you're seeing right now is a 2-year bond will actually pay you out more than a 10-year bond by 31 basis points, by 0.31%, which is quite substantial if you're somebody that plays in the bond markets and you're dealing with billions of dollars. That 0.31% makes all of the difference. So you're actually seeing the yield curve inversion steepening a lot more today, heading into the next Fed rate hike, which is today. It's very interesting that the markets are really brushing this off as of right now, when we have inverted so fast with the yield curve. So pretty interesting, something you guys definitely want to pay attention to. As far as the overall option activity for the day on the S&P 500, let's go ahead and refresh this page. We could see that the positive order value is 81% for the day, slightly lower than what we have seen over the past couple of days, and you're looking at about 1,500 orders totaling $148.77 million. So a kind of lower than average dollar amount for the day. I think a lot of people are waiting for the Fed to see what happens with that, but a lot of call activity that is coming in, and it looks like the market makers are just going to pump the markets and do whatever they want to do here in the short term, because hey, they can. They are the market makers. They create the markets. But don't be confused. The thing that we have seen over the last two Fed meetings so far is we have seen a very bullish day of the Fed meeting. We have seen a 3.5% rally after Powell talks 2 times in a row. And then what has happened the next day after? You have given back all of those gains plus some. So if we rally 3% today, well, what we've seen over the last 2 Fed meetings is a 3.5-4% drop the next day. So be mindful of that. That is also when we have Apple and Amazon earnings tomorrow, which could help or hurt the overall, rally potentially that we could see today because of the Fed. So there you guys have all of that. I do want to switch gears here and talk about AMC stock and where AMC fits into all of this. So the option activity for AMC as of right now, as of this Friday, the open interest is sitting at about 74% calls and about 26% puts. So a lot of people are expecting a bullish rally out of AMC stock by the end of this week. For today, you're not really seeing a lot of option activity, and I think that's why AMC is pretty flat on the day, sitting at about $14 per share flat and down about 0.29%. You have only seen one order totaling $37,000, positive order value of 100%, and that is actually a September 16th $16 call for that $37,000. Now, as far as the short interest, you're looking at 19.5% estimated short interest of free flow, $1.41 billion worth of shares that are sold short. Free flow out on loan, 27.75%. Shares out on loan, 143.06 million shares. Days to cover, 3.42. Cost to borrow, 9.9. 100% share utilization. Now, you are seeing the cost to borrow max jumping up a little bit today. Now at 12.23%. Cost to borrow average at 9.55%, and cost to borrow minimum at 6.91%. So all in all, when you look at this, something to be pretty bullish about. The estimated short interest going up about 1% over the last 7 days, which is very bullish, going from 18.5 to 19.5%. If we do get a bullish reaction out of the markets today, if the markets like what the Fed has to say, which we will cover that here on this channel, and that will be the most important video that you guys want to watch, because that's either going to give us more downside or that's going to give us a hell of a bullish rally from here. Well, that is going to really dictate how AMC stock moves. If the markets rally, I think it's pretty clear that AMC stock will rally as well, especially if you get a broad-based rally. And the thing to really watch for above everything else, even if you don't watch the video later, if we see a bullish rally throughout the rest of the day, if the Fed does not U-turn the markets, then it's very possible and probably likely that we get a massive red day tomorrow. That's what we have seen over the last 2 Fed meetings. This would be the 3rd one in a row if that pattern does play out. Now, it all depends on what the Fed says, so you guys definitely want to stay tuned for those videos later on today as well. Now, the option activity for AMC stock by the end of this week, you're looking at about 119,000 calls that are currently out of the money, about 6,000 calls that are currently in the money. Now, on the put side, you have about 19,000 puts that are currently in the money as well. So you have a decent amount of dry powder on the sidelines. If we do see the stock go up in a big way, break out above $15 again, that's going to be very bullish, and you're going to see a lot of calls go into the money and a lot of puts go out of the money, and that will constitute the market makers going out and buying stock on the open markets. Now, as far as AMC on a technical basis, we want to watch that 50-day moving average that is sitting at $13.48 per share. We are about 50 cents off of that now, so it looks like we're probably going to hold that level throughout the rest of the day, unless, you know, obviously the Fed causes a big downside move, which it's going to be very volatile, so expect the unexpected. Anything can really happen, a big rally or a big drop. You know, I'm expecting one or the other. Now, we are you know, approaching the 50-day moving average. I think we'll hold support there. If we don't, and the markets just see a big colossal move to the downside, $11 per share is a very real possibility if we drop another 10 or 15% in the markets to come down and hit new lows and go lower than those lows for the S&P 500. Now, you are seeing a very low volume day for the day, about 11.5 million shares that are trading hands. I believe it's a low volume day for the S&P 500 as well. Yeah, super low volume day so far. 17.5 million shares that have traded hands. What's actually happening is the markets are waiting for Fed Jerome Powell. The markets are waiting for new information, and then we will get the real move from there. This low volume day could turn on a drop of a dime, so be careful of that. Now, the RSI is at 46.19, so under that neutral level, getting close to those oversold levels, as this is the 1, 2, 3, 4, 5th red day in a row. MACD now firmly in bearish territory, and from everything that we have covered, it looks like we're going to get a rally, especially around AMC's earnings coming on August 4th. It's pretty hard to be bearish on services, right? On not necessarily products, but services. People are going out and they are doing things. People are going on vacations. People are going out and living after they have been stuck inside over the past 2 years. That's the last place in the markets that I would want to be going short on if I were a hedge fund. AMC is in that sector of the economy that you just don't want to be short on. People are going to see movies, as there are a lot of big movies that are currently in theaters, and a lot of people expect AMC to post very good revenue and potentially earnings numbers in this next upcoming quarter. So that is going to be all for this video. Hit that like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. Thank you guys for tuning in. You guys enjoy the rest of your day. I will see you in the next one.